quick video about what typical high frequency traders utilize, which is bid ask spread difference or inefficiency. Um, so, what that typically means is under stable, normal, high volume conditions, such as typical trading hours for the SPY and ES outside of 9:30 to 10:30, where you have that volatility spike. What you're going to see is, if you look right here, I have the SPY options up. The difference between bid and ask is 1 cent. But on a huge scale, if you're doing 10,000 contracts with a limit order that gets filled repeatedly and repeatedly and repeatedly, with some system that allows for the understanding of when this price isn't fully reflective of the side. And what I mean is when this is, okay, you just saw this go from 1-1 to 1-2, or maybe I'm tweaking, but if it was, for instance, 1-1, then to 1-2, all right, and it right before it ticks, they're able to get filled at 1-1 and then sell for 0-2 and make a 1 cent profit repeatedly. Um, that only works in very stable conditions and very high volume conditions, um, which is why typically if you see some lunch chop or some afternoon session chop, I'm pretty sure that's a really good period for high frequency traders because that's when you have a lot of portfolio efficiency managing for like uh, when you're not really looking for your overall managed position, but when you're looking to manage after the daily movement, there's some chop, and that's usually when there's a lot of volume, but not a lot of direction, and that's why frequency traders profit off of. Um, to kind of show this, illustrate a little more, I don't really have very much more to say. This is going to be a quick video, uh, but it's a pretty simple topic. You trade this small difference by the change, by the very small change, and you can build machine learning systems. And this is for very expensive high frequency trading systems. Um, but for instance, if we go to Apple options, there's going to be, since there's less volume traded for Apple than the SPY, you're going to see a bigger difference in the uh, ask bid. What this means for price movement wise, typically, is that trends are harder to be created because you have more resistance and more volume around the center of price than towards a point. Like for instance, if you have a large order, say 5,000 contracts, that's looking to buy Apple with a 6 cent difference in bid and ask, um, that is gonna have a lot more directional impact on buy pressure and or yeah, it's gonna have a lot of more directional impact on uh, creating a bullish trend than say if you have 10,000, 5,000 contracts of a 1 cent difference that could just get chopped up into the high frequency cycle, um, and you could just uh, either not profit or largely because like I said last video, they're not really looking to profit, largely not have your risk managed the way that you want it to and have to kind of become the loser for the day. Um, which is also, so that doesn't really have to do with this. Yeah, maybe I should just wrap this uh up. Yeah. I think this is good. All right, bid ask spread. Cha-ching. One thing you can see is typically there's a either a volume analysis here. I'm not logged into my account. That's hilarious. Anyways, there's usually like a volume analysis here, or if you have some form of ability to see volume analysis, typically it'll look like a inverse standard deviation curve where you have both a left and right, like typical 50% skew for the SPY, even when you have directional trading, which just goes to show how much volume there is and how much uh, resistance there is for directional trading. Yeah, but that's enough. See you on the next one. Videos will come out pretty frequently. I'm not gonna do a lot of editing or any crazy style. Just gonna try to be informative and share what I'm learning now.